The mechanics of buying stocks. Chapter 1. Stock types and indexes. Types of stocks/industry sectors. There are basically two major sectors of the economy, goods and services. Sector mutual funds are mutual funds or ETFs that invest in companies that all belong to the same industry. The main sectors are aerospace, automobiles, banks, basic materials, biotechnology, capital goods, chemicals, communication services, computers, consumer cyclicals, products bought in one season like lawnmowers in the spring, consumer discretionary, consumer staples, products sold year-round like bread, defense and aerospace, defense contractors, drugs, electronics, energy, financial, food and beverage, gaming, healthcare, home building/housing, industrials, insurance, medical equipment, metals and minerals, nanotechnology, oil and gas exploration, paper and chemicals, real estate, retail, solar energy, technology, transportation, utilities, water resources. Blue chip stocks are the safest stocks, consisting of large companies with stable records of performance like AT&T and Coca-Cola. Cyclical stocks are companies whose performance reflects the current state of the economy like home building and automobile makers. When times are good, people buy new cars and new houses. When times are bad, they don't. Large cap stocks are companies with over $1 billion in assets, mid-cap stocks are companies with $500 million to $1 billion in assets, and small-cap stocks are companies with less than $500 million in assets. Defensive stocks are companies that provide the staples like utilities and supermarkets. They're stable, but if the market grows as a whole, they don't grow as much. Income stocks pay a reasonable dividend like getting interest on a CD at a bank, and the prices generally don't fluctuate much. A lot of utilities fall into this category. Growth stocks are companies that are consistently experiencing good growth of revenues and earnings. Prices of these stocks may be high in relation to the company's assets because they figure in the future potential growth of the company. What constitutes a growth stock is always changing as the market changes, but food, drugs, and tampons are basic growth stocks because people always need them and there are always more people. Speculative or aggressive growth stocks are risky but offer the possibility of large gains, such as a company that sells only one product, tech stocks, or any type of mineral exploration. International stocks from other countries are coming into vogue because they're unrelated to the American stock system and could be up when ours are down, so consider investing in some overseas stocks. Foreign stocks are subject to the same regulations as American stocks. Value stocks are inexpensive stocks of companies that are going through difficult times. Balanced stocks are companies that have some of their assets in stocks and some in bonds. Some stock indexes info. Indexes are merely categories stock analysts assign certain specific stocks to in order to try to get a feel or pulse for that sector of the economy. Some mutual fund companies create mutual funds based on these indexes, but beyond that, they're just a tool which an investor uses among the variety of tools he has at his disposal to stay informed about the current state of different sectors of the economy. The Dow Jones Stock Index. The Dow Jones Stock Index is made up of 4 indices: industrial, transportation, utilities, composite. The Dow Jones Industrial Stock Index, made up of 30 stocks of the major companies in the U.S., is the one you usually hear about on the evening news. The industrial average is based on the stocks of 30 leading manufacturers and distributors. The Dow Jones Transportation Average. This indicator tracks intermediate trends between bull and bear markets, 20 stocks. The Dow Jones Utilities Average. This long-term lead indicator shows the condition of sensitive income and interest stocks. The Utility Index comprises the average of prices for 15 utilities. The Transportation Index covers 20 railroads, airlines, and trucking companies. Dow Jones Composite Average combines the three indexes, industrials, transportation, and utilities, 65 stocks. Although trends on the Dow Jones Industrial Average are reliable sources of market information, it is not the only method for predicting market movements. Other stock indexes. The Standard & Poor's 500, 400, and 600 indexes contain more stocks, but the indexes move together with very little disparity. There are several other indices, Amex, Nasdaq, NYSE, Wilshire's 5000 and several foreign indexes. The quadrant change. This indicator is especially effective if you have mutual funds because funds track more closely to quadrant than to the Dow. Quadrant lets you know what the market is doing in broad terms, on both the New York and American stock exchanges. The over-the-counter/OTC Composite Index. This index shows the cumulative performance of over-the-counter issues. If you see it outpacing the Dow, get ready for a bull market. If the index is weaker than the Dow, plan for a bear market. TRIN, Trading Index. This indicator tracks the volume of rising and declining issues. When you have a bull market, TRIN falls from above 1.20 to below 0.70 during one trading day. When the market is bearish, TRIN goes from below 0.70 to above 1.20. If TRIN registers 1.00, this means there is an even relationship between declining and advancing stocks. The ticker news service known as the board tape is the electronic billboard of sorts which constantly spews out stock prices while stocks are being traded during the day. J.P. Morgan Global Government Bond, 500 bonds from 12 countries. Morgan Stanley Capital International, MSCI Europe, 600 stocks of European countries. Morgan Stanley Capital International, MSCI Europe, Australia, Asia, 1,500 stocks representing 21 countries in the three areas. Morgan Stanley Capital International, MSCI Emerging Markets, 1,200 stocks worldwide in emerging markets. Nasdaq 100. Nikkei, 225 stocks in Tokyo. NMS Comp, Nasdaq Market System Composite. NYSE Composite. Russell 2000. Russell 3000. Schwab 1000. Standard & Poor, S&P 500, S&P Midcap 400, Small Cap 600. SOX, Semiconductor Sector on Philadelphia Stock Exchange. Wilshire 5000, 4500. WSX, Wilshire Small Cap Index. Canada Stock Indexes. XAU, Gold and Silver Index. SCM Universe Bond. TSE 60, Toronto Stock Exchange. TSE 200. TSE 300. Stock Index Websites. Russell.com/indexes/default.asp, Russell US Equity Indexes. DJindexes.com. DowJones.wsj.com. Indexes.dowjones.com. StandardandPoor's.com. Chapter 2. Buying Stocks Guide. How to buy a stock. When buying stocks, there are full-service brokerage firms which presumably offer financial advice and charge full commissions. There are discount brokerage houses which offer no advice but take trades over the phone or over the internet for a much lower cost than full-service firms. The biggest of these is Charles Schwab with 232 offices nationwide. The lowest fees of all come from the deep discounters like Pacific Brokerage, National Discount, Freedom Investments, eTrade.com, Ameritrade.com, and Lombard.com. Internet trading is the cheapest way to go. Stocks are sold in three basic ways. The full brokerage houses who offer you advice and charge significant commissions. The discount brokerage companies who charge low commissions and generally sell the stock without offering advice. No-load stocks/DRIPs, dividend reinvestment plans where the companies sell some of their own stock themselves directly to the investor without commission. Generally, there are two ways to buy securities. Cash account where you must pay full value within 5 days of the purchase. A margin account is an account where the investor pays for part of the purchase price and the brokerage lends him the rest at a specified interest rate. The broker will first check out your credit rating to determine if you are worthy of having a margin account. The Federal Reserve Board sets the percentage the margin investor must pay. Some brokers have a higher rate and there are some securities that you can't buy on margin. The investor pays interest on the value he borrows from the brokerage on his margin account. If the stocks lose value, the brokerage might liquidate your account to recover their losses. A margin call is when the broker demands full payment for the stock you purchased. The National Association of Securities Dealers and the SECs have put together a margin disclosure statement which sets you straight on margin investing and alerts you to the risks. Ask your brokerage dealer for a copy of this statement. The basic points are: you can lose more funds than you deposit in the margin account, thus you could end up owing money. The firm can force the sale of securities in your account. The firm can sell your securities without contacting you, as in the case of a margin call. You are not entitled to choose which security in your margin account is liquidated or sold to meet a margin call. The firm can increase its house maintenance margin requirements at any time and is not required to provide you with advance written notice. You are not entitled to an extension of time on a margin call. The bid is the highest price you, the buyer, are willing to pay for a stock. The ask is the lowest price that sellers are willing to sell for. The bid is the price you get when you sell the stock. The ask is the price you pay for it. A day order is where you tell your broker to buy or sell a particular stock at a certain price for that day only. A discretionary account is one where the investor gives the broker the right to trade his securities at will or when certain conditions are met, such as when the stock reaches a certain price, the broker either buys or sells. When trading stocks, you usually buy in 100 lots called round lots. Anything less is called an odd lot. Do you need a stockbroker? I don't trust most stockbrokers because their bottom line is to make money through commissions and not necessarily to make you money. With drips/no loads and discount online brokerages, you can do it all yourself, save the commission fees and trust your own judgments over those of anyone else. Despite the big bucks spent by brokerage firms designed to convince you that you need them for advice, the truth is that you don't. All it takes is a bit of homework and an ability to take advantage of free or cheap information available to you in any library or online. There is nothing wrong with using a reputable brokerage firm to handle your market transactions, but don't be dazzled by the poo-root knowledge of your assigned stockbroker. They're not much more knowledgeable than you about stocks and will charge you a hefty price for their services. Furthermore, they probably have a vested interest in pushing certain stocks. Full brokerage firms technically offer advice on how to invest your money, but sometimes you can run into serious trouble with a stockbroker if you are not paying attention. Investment companies hire them on commission, so basically, they don't care who they hire because the stockbroker is pretty well on his own, and whatever he makes, the company gets a piece of the action, so they don't really give a damn who they got working for them, and that means all kinds of shady guys get into the stockbroker scene for a while, pull a scam and they're gone. Churning is a term used to denote an unscrupulous broker who trades frequently to generate commission fees for himself. Limit orders. A market order is simply buying stocks at the current price, whatever it might be. However, there are limit orders where you instruct your broker to either buy or sell when the stock reaches certain limits. Limit orders can be made for the day, month, etc. GTM, good this month order. Stop loss, sell when the stock drops to a certain level. GTC, good till cancelled order. Tell your broker to buy or sell when the stock reaches a certain price regardless of the time constraints. Stop order, you instruct your broker to sell when the stock reaches a certain value. The beauty of GTC orders are that if you like a company but want to save money, you simply put in an order that you will buy the stock if it sells for $5 to $10 below current value. Then if it dips down quickly due to a momentary lapse in the market, you get it for cheaper and it rebounds quickly, but you might miss the chance if it doesn't go down to that level. Short selling stocks when the value goes down. In a sentence, short selling is borrowing a stock, selling it at the going rate, hoping it goes down, then you buy it for real at the lower price, give it back to the owner and pocket the difference. Borrow shares from your investment dealer through a margin account and immediately sell them on the open market. The proceeds are then deposited into your account. Eventually you repurchase the shares and return them to the dealer to close out the short position. If you pay less to buy them back than you received from selling them, you keep the difference minus the trading fee. If it goes down, you make money. If it goes up, you lose money, possibly more than your original investment if the stock goes up too high. You can only get this borrowing option from some brokerages and for only some stocks. It helps if you have lots of money in your account to cover any losses should the price go up. So you start off asking your broker to lend you X number of shares of ZZ which he lends you and expects you to return in a day or so. Your account is credited with these shares of ZZ Corp which you sell on the open market at the going price. If the price goes down, that means you will buy X number of shares at this lower price to return to your broker, thus keeping the difference from what you sold it for yesterday. If the price goes up, you have to buy it at that higher price in order to return it to your broker. Some other terms that go along with short selling are margin call. When you borrow stocks on margin, you should have enough money in your account to cover possible losses. A margin call is a demand to cash out now and pay what you owe. A buy-in means the broker wants his shares back. Short squeeze, a losing stock suddenly starts to rise. Short sellers panic and terminate the deal. The uptick rule, a stock can't be sold short unless the price paid for the shares is equal or higher than a previous sale. Conceivably, your greatest profit would be when the stock price drops to zero after you've sold it and the price could rise infinitely high, which means you would have to buy at that price in order to return it and the losses could be staggering. When you borrow the shares from your brokerage, he gets those shares from either one of his other customers' margin accounts or borrows them from another broker. This is a reverse intuitive stock trade. When you open a margin account, you sign an agreement with your broker giving him the authority to lend out some of the stocks you own on margin. This is where the term short selling comes in. He lends some stock to another investor for a fee who anticipates that the price will go down, therefore he sells it on the open market. Then when it goes down in price, he buys it back at the lower price, returns it to the broker and makes a profit. Of course, he loses if the price goes up. Most short selling is not done by individual investors from the public but rather by members of the stock exchanges. With real stock trading, you can only lose 100% of the stocks you own, but with short selling, you can lose even more than that depending on how the stock changes in price. Options trading is something like short selling, although a bit different. You use puts and calls. You buy a put, sell a call. A put is an option to sell a stock at a specific price at any time before the option's expiration date. A call is an option to buy a stock at a specific price at any time before the option's expiration date. Not all stocks have options. You buy options through some brokerages. Some mutual funds, called long-short funds, use short selling as a part of their strategy. Short selling is a speculative strategy with high risks. If the price rises instead of falling, you lose money. The potential loss is unlimited. The stock could go way up and you have to pay the price to return them to the owner. You must by law open a margin account with your dealer before you can short sell. Only a few investors are ever trusted enough to get margin account status. Manuel P. Asenio has made a lot of money by finding deceptive, fraudulent, overvalued companies, selling their stock short, exposing them, then cashing in when the stock crashes. This is not illegal unless you spread lies about a company. He wrote a book about it called Sold Short, Uncovering Deception in the Markets. Type his name into a search engine or go to asenio.com. The concept is to be good at spotting when stocks are likely to go down in price, then cash in by short selling. The best times to short sell are as follows. When the whole stock market is tanking. The stock has had a good ride in momentum based on rumor. The stock rose very quickly. The stock had a good earnings report. Everybody bought some. The stock split. Everybody bought some, now it's settling down. After an IPO lockup, the company's officers cashed in a lot of their chips, but the company is good. Expect the price to rise again. A company had an IPO spin-off. Now the hype is over after a month or so. It's too complicated and muddled for me. Either read about it at the following websites or stay away from it. Try number 332.63228 or HG6041 at the library. PrudentBear.com. TrendFund.com. How to read a stock listing. Every newspaper and magazine has their own unique manner of stock listings. In addition, companies have dividend listings and quarterly earnings reports. Learn them and study them. A generic stock listing has the following categories. 52-week. High-low stock DIVPEYLD vol high-low close net change. 2214 Acme .984.5 2018.5 20 plus 1/4. Fractions are merely the partial value of a dollar. 52-week high and low shows the highest and the lowest price of the stock during the past year. Stock is the company name. DIV is the annual dividend per share, so for every share you own, you get 90 cents a year. PE is the price-earning ratio. YLD is the dividend yield, the annual dividend per share divided by the closing price of the stock. Vol is the number of shares that traded the previous day times 100 from what's listed in the table, so 300 means that 300,000 shares of Acme were traded yesterday. High is the daily high price of the stock. Low is the daily low of the stock. Close is the price the stock closed at that day. Net change is the change in the value of the stock from yesterday's closing to today's closing. Chapter 3. Stock sellers. Brokerage analysis websites. These websites give opinions and commentaries about brokerages. ConsumerReports.org. InternetInvesting.com. Money.cnn.com/bestbrokers, bestbrokers. MSmoney.com. OnlineInvestor.com. SmartMoney.com/SI/brokers. Brokerages/financial management firms. Brokerages mainly do two things. They sell stock. Underwrite companies going public, that is, they exclusively sell the stock of companies that are offering shares for the first time. They are supposed to do research and offer advice for a reasonably high commission fee or possibly for a flat fee in what is called a full brokerage firm, which means they offer advice for a fee as opposed to a discount brokerage firm which offers no advice, only sells stock. Brokers are licensed to sell stocks. Financial managers/advisors may have a broker's license, they may not. Their job is to help you diversify your money, what is poetically called your portfolio, so you have got a bit everywhere to cover all the bases from conservative bonds to aggressive high-tech stocks. Most brokers and advisors don't just deal in stocks, they offer bonds, mutual funds, certificates of deposit, retirement planning, etc. Discount brokerages execute trades but don't offer any advice for a lower fee than the full brokerage firms. For a huge list of brokers, go to any internet telephone directory. Many of these websites have free financial information on them. Lists of stockbroker websites. Brokers.fool.com. Findbrokers.com. FPA.org, Financial Planning Association. IAFP.org, International Association of Financial Planners. InvestorGuide.com/brokerages.htm. Keynote.com/measures/brokers. NIBE.com, Institutional Brokers. NAPFA.org, National Association of Personal Financial Advisors. NationalRegistry.com, go there to check out public record of your broker. Brokerage firm websites. 1800daytrade.com, brokerage. A1financial.com, brokerage. abwatley.com, AB Watley Inc. abwatley.com, brokerage. af.com, Massachusetts. agedwards.com, brokerage. allendale-inc.com, brokerage. Ameritrade.com, Ameritrade, online brokerage. Amerivet.com, brokerage. AndersonCompany.com, brokerage. aintcapital.com, arab-busines.net, aramex.com, atradersech.com.